afternoon, good evening, traders. This is an FX trader. So it has been a while, but there's a reason for that. I really had actually broke my wrist, so it had really hindered me from making these videos. But I'm back, fully not healed as yet. But I wanted to quickly come on here because we want to continue the series on simple forex strategies. So what we're going to be focusing on in this series is divergence. Our focus is going to be on divergence. Now, what is divergence? When we speak about divergence in the context of investing, in the context of forex or stock market trading, what we are looking at is that we're looking to see where price, and when you compare price and you compare an oscillator, now that oscillator may be the stochastic oscillator, it may be the RSI, it may be what I'm using here, the commodity channel index, CCI. What we're looking for is when price is going one way and momentum is going in the other direction. So in this example, what we look for when we look for divergence is that if price is making lower lows, so you can see here that we have moved from one low to a lower low, but on the oscillator and the indicator that we are using, when we compare these 2 points, this low to this low is moving from a low to a higher low, but price is moving from a low to a lower low. So when you see this, this is what is referred to as divergence, because in most instances price and your oscillator, your indicator, should be moving in the same direction. So when price is going down, your oscillator is going down. When price is going up, your oscillator should be going up. But when they are moving in opposite direction, it's actually a sign that the momentum is slowing down, right? And that you could have a reversal or expect a reversal. Divergence is really actually one of the best strategies out there, used by professional traders. You can decide as a trader to use this strategy alone. You can decide that this is how you are going to trade the forex market only. One of the key things about this is that it actually helps you to get in the market right where the turn is going to happen. It actually gets you in the market right at the high or right at the low of the turn, so you get a very good entry, right? Soon as you enter, you can be looking to move into profit once it is executed properly. Okay, now when we talk about divergence, you have bullish divergence and you have bearish divergence. Now, simply put, when we are talking about bullish divergence, so we already understand the concept of divergence, that momentum and price is moving in opposite direction. And when I speak about momentum, I'm talking about your oscillator, your indicator. And like I said, that can be MACD, can be RSI, can be CCI, can be stochastic, anything that you prefer to use. Okay? So when we talk about bullish divergence, is of course we're expecting the market to go bullish, we're expecting the market to go up. So you know you have a bullish divergence when you're going to be comparing lows, right? Because when you decide to buy the market, you want to buy the market low. So just think about bullish buying low. Okay, so you have a bullish divergence when you're going to be comparing lows. Okay, that's the first thing. So in this example, you can see that we're comparing the lows. We're comparing the low here. Okay, we're comparing this low to this low, and likewise on the indicator, we're comparing lows. You can see with this low here to this low here. And that is how you know that you're looking at a bullish divergence when you're comparing lows. Now you have a bearish divergence. Let me just go to this. You have a bearish divergence when you're comparing highs. Okay, so in this example, you have price moving from a high to a higher high, but on the indicator, momentum indicator, you're moving from a high to a lower high. Okay, so once you're comparing highs, you're talking about bearish. You're looking to sell the market. Okay, so let's just break that down so far. Divergence itself is when price and momentum are moving in opposite direction. But then you have bearish divergence and you have bullish divergence. You have bearish divergence when you're comparing highs. So you must compare the same high point of the price, right, with the oscillator. So if you're comparing this high right here with this high, they're moving from a high to a higher high. You need to also go from a high, look for a high, look into a lower high. So in this sense, you have bearish divergence. Bearish because you're comparing highs. Divergence because the price and the oscillator are moving in opposite direction. So that's how you get those terms. Okay? Now, you have what is called regular divergence, or it is sometimes called classic divergence, and you have what is called, let's zoom this here, hidden divergence. Okay? Now, regular divergence, okay, is when price is making lower lows. Okay, so you look at, you have regular divergence when you're looking for a reversal. Okay, and that is when price, on the price chart, price is making lower lows. Okay, and so you're looking for a reversal. Okay, price is making lower lows, the momentum indicator is making higher lows, so you're looking for a reversal. You have hidden divergence when price is making higher lows, okay, while the momentum is making lower lows. Hidden divergence is the continuation pattern. You're continuing in the current trend. So let's think about this, for instance. Let's focus on the hidden bullish divergence. Now, when we talk about a bullish trend, or when the market is moving bullish, right, it means that the market is making higher highs and higher lows. So, for instance, you see that this high is higher than this high, and this high is higher than this high. So you're making higher highs from here, right? You're making higher highs from here to here to here. You're making higher highs, okay? So this is a bullish trend. So you're making higher highs and higher lows, okay? So you're making a higher lows down here, all right? Now, this helps you to identify that you are in an uptrend, you're in a bullish trend. Now, if you're looking to get into the market, but you want to get in at a low price, because remember, you're looking to buy. When you buy, you want to buy low. So you're thinking bullish. So what you do is that you're comparing, okay, and this is the key, you're comparing lows, okay, because once you're going to buy, once you're going bullish, you want to think buying low, okay, so you compare lows. So when the market makes this low and it is higher than this low, but you look on your indicator and you see that this low, right, you move from a low to a lower low, but on the price chart you move from a low to a higher low. That is hidden bullish divergence. Okay, and that's a continuation pattern. But regular bullish divergence is when price makes from a low to a lower low, and the indicator goes from a low to a higher low. So you're expecting a reversal. Okay, so this is how it plays out. So to break it down, we go again. Divergence is when price, action, and your indicator, your momentum indicator, are moving in opposite direction. So that's how we get the term divergence. Bullish is because we are looking to buy and we're comparing lows. So that's where you get the bullish. Once you're looking to compare lows, once you have identified the divergence, by comparing the lows, it's going to be a bullish divergence. Okay? It is a regular or a classic bullish divergence if you move from a low to a lower low on the price chart. Okay? And it is a hidden bullish divergence if you're moving from a low to a higher low. Right? And this is a continuation pattern, whilst this is a reversal pattern. Right? So this is where that the market was going down, and then when you identify the divergence, you're expecting a reversal, and that's exactly what took place here. The market that was going down reversed and started going up, right exactly where you are identifying the divergence. Okay? And this is a continuation pattern. The market was already going up, and you decide that you want to enter into this uptrend. Okay, so you already identified that the market is going up, it's in an uptrend, and you want to get in, but you want to get in at a low price, right? You want to get in at a low price. So one of the ways of getting in the market when it is already moving in a trend is to look for divergence. And you can look for divergence on any time frame, right? The 4 hour, the daily, the 1 hour. You can look for divergence and you can enter. Okay? So there are 4 types of divergences. I'm just going to identify them. You have the regular bullish divergence, and you have the hidden bullish divergence. Okay? In both cases, we compare the lows because you're thinking bullish. But then you have bearish divergence, okay? And you have a regular bearish divergence because price has made a high to a higher high, but the momentum indicator has gone from a high to a lower high. So once you're comparing highs, you want to think bearish. It is regular because you're looking for a reversal. Okay, so you see here that the market was going up. From here to here, the market was going up, and then when it hit this point, it reversed and went down. So that is a regular bullish divergence. A hidden bullish divergence. Where did I put the hidden? Okay, here it is. A hidden bullish divergence. Sorry about that. A hidden bullish divergence is when the market is already making lower lows and lower highs, right? So you already see that it is in a downtrend, and you want to find a way to get in the trend, but you want to sell the market, and you want to sell it high, because if the market is going down, the market is bearish. So you want to join in the trend, but you want to sell at the highest possible price. So in this case, you're looking for a continuation of the move, or you're looking for price to move from a high to a lower high, but the momentum goes from a high to a higher high. So as you can see here, you'll be able to enter right here, and then as soon as you enter at this, the market drops. So you get a very good entry. So if you see that the market is moving in a downtrend and you want to sell the market, but you don't want to sell low, but you want to sell high, that's the best possible entry. So you look for a hidden bearish divergence, and you look for it on any time frame, and you get in. Okay? And if the market was going up, right, and you want to get in on the trend, then you look for a hidden bullish divergence. So that is a continuation pattern. So I just want you to, in this video, I wanted to just introduce that, let that soak in, and then on the next videos, we will actually look for opportunities. This opportunity just happened. I had posted this trade to go long in my Telegram channel because I spotted this divergence. So a quick recap, you can look for divergence using any indicator of your choice. Okay, I particularly like the CCI 25. So the settings on this, let me just show you. So I'm using the commodity channel index. Okay, I am using a period of 25. I'm applying it to close, right? The levels do not matter. Okay, the standard levels are normally negative 100 and 100. I like to use negative 200 and 200. That lets me know, especially when price is really overbought or oversold. But I'm not trading based on that. Okay, I'm using it specifically for divergence. Okay, so therefore the levels do not matter to me. Right? So that is it for now. So I want you to just continue to watch this video. Of course, you can, you know, be a part of my free Telegram channel where I post trades. Right? That's where I do most of my postings. So join the free Telegram channel. You will see the link below. All right, and we will continue in this series next week with another video. So this is Ed FX Trader signing out.